Welcome to the FNO InsureTech podcast, a place where movers and shakers from all points within the insurance ecosystem gather and discuss all things InsureTech. We talk about how technology and innovation are affecting and driving change in the industry. Here are your hosts, Lee Boyd and Rob Beller.
Hey, podcast world. Welcome to the 795th episode of FNO InsureTech.
That's almost right.
I was a little, that was an I exaggerate a little bit.
Of an exaggeration.
I exaggerate a little bit because the quality of our guest today is so high. You'd think, oh my gosh, they must have over 700 episodes.
You would think that. You would think that.
Truth be told, we don't. We only have several hundred, but that's not important. What's important is welcome to another amazing, incredible, stupendous, and super interesting and informative episode of FNO InsureTech, your leader in the world of InsureTech podcasts.
That's right. We are the leader.
Often imitated, never surpassed.
You've been thinking about that one, haven't you?
No, actually, it just came to me in the moment. How are you, Lee? What's going on? I put you on the spot, didn't I?
You did. You did. You know, Rob, so here's the thing. I work at home these days.
Yeah.
And so sometimes I leave my window open. And right now my wife and my neighbor are speaking right outside the window.
Yeah, we can hear it in the background.
It's a little bit, so I don't know what to do about that.
Mm-hmm. Yeah, we hear it. That's how homey our podcast is.
That is how homey it is. We bring it straight from our homes to yours.
You can hear our significant others talking in the background.
That's right. Yeah. Literally just standing right there.
Because we're sharing the bathroom with them while we're doing the podcast.
That's right. So it's a very exciting time. Very exciting time.
Well, so about a minute ago, that's right. In case you're wondering, Lee's studio and office are in his garage.
That's right.
As are his cars. So,
as are my cars. My wife parked right outside, which is great. But like I said, my garage window and my garage door are open, so I can hear everything.
Lee's still adjusting to this whole at-home work thing.
It has taken a little bit of time.
But now we're going to talk about something much more interesting, and that's our guest today.
Yeah.
So sometimes we have on guests who we've never heard of.
Yeah.
And sometimes from organizations that we've never heard of, who do things that we've never heard of. Is that fair to say?
That is fair to say. There have been those times that somebody came on and we said, who in the world is this and what in the world do they do?
That's not today.
That is not today.
Because sometimes we have on guests who we've heard of.
Yeah.
Who run companies that we've heard of.
Mm-hmm.
And who influence the entire ecosystem of the insurance industry in very important ways. And that's our guest today.
Yeah. I don't think that we can build this company and the guest up enough because of how pivotal they are in the insurance space. You can't Google a major insurance carrier without seeing the name AM Best, right?
That's right. And we have today the president and CEO, Matt Mosher, as our guest on FNO InsureTech. And you're gonna love this interview.
You are. Matt's going to talk all about what AM Best Rating Services is, how it started, the importance of it, how someone gets the rating, what it means. And then we're going to dive into a little bit about how InsureTech and MGAs and banking are all issues or good or bad within the insurance space. So it's going to be a good conversation.
And even a little really interesting perspective on climate change.
Yes, you did. Yeah.
And the climate change debate, and is it or is it not? And so you'll hear about all that, but a wonderful, pleasant, very intelligent, very accomplished man, And these are the kind of interviews that you've come to expect from
It's a big
FNO
deal.
InsureTech. Big deal.
Big deal.
So without further ado.
Hey, should we also say a shout out to AM Best TV for having us on?
That's
I'm pretty sure we should say that.
Why don't you go ahead?
We want to say thank you to AM Best TV. If you haven't had an opportunity to look at AM Best TV, Rob and I did an interview with them where they asked all about the podcast, kind of the founding story and how it's changed. And we really appreciated them letting us on, and we enjoyed it. So if you haven't had a chance, look that up. I'm sure Al can get that posted to the socials again.
If you're wondering why it's often been said that Lee and I have a face for radio.
Yeah, you have said that numerous times.
You watch this episode of AM Best Television, and you
can also see my at-home office and see that it doesn't look like I work in a garage, just in a wood shop.
Okay.
Wood shop.
So without further ado, here is our interview with the president and CEO of AM Best Rating Services, Matt Mosher. Hey, everybody. We are here with a luminary, a very special guest for our little podcast to have on. We have Matt Mosher with us today. Matt is the president and CEO of AM Best Rating Services. Welcome to FNO InsureTech. Thanks for coming.
Welcome, Matt.
Thank you, guys. I really appreciate you having me on.
Well,
we're excited to get to talk to you today.
It's a privilege to have you with us. We know that you're a busy man who has your hands in a lot of pots, and that's what we want to talk about today is what the heck you do and who is this AM Best Rating Services. So let's start there. In the information on your company, I found that AM Best Rating Services our purpose is to strengthen the financial solvency, stability, and sustainability of the insurance industry in support of economic growth and well-being of stakeholders. That sounds like a lot.
Thank you for reading it, because it really is the premise of, and whenever anybody asks me what is AM Best about, that's what I go back to. It really does matter. The fact that we're focused on that and that our employees understand that that's what we're focused on. Otherwise, you can get off the track and go down and look at new things. You can look at growth. You can look at all kinds of different aspects that take your employees' focus off of what you're really trying to do. And I use the example all the time. If our analysts are not asking the right questions, somebody might not get paid for an insurance claim. And, we are there to make sure that companies are operating in a standard that supports their policyholders. And that's what our ratings are about. It kind of differentiates the strong from the weak, and the better performers and servicers in the insurance industry from the weaker insurance industry. So that purpose is what we live and die by in terms of our overall operation.
So does that make you guys kind of scary to a lot of people in the insurance industry? It's like, oh no, AM Best is knocking at the door. What do we do? Hide, don't answer. But seriously, you're an important part of the whole ecosystem of what holds this thing up. Is that correct? And that's a kind of a powerful perch that you guys sit on. Is that fair to say?
We get that from companies, and there are companies that look at it from the perspective of, oh no, AM Best. And we work very hard to have companies understand that this is a dialogue and working back and forth. We are not allowed to be a consultant. We're not allowed to give advice. We can only evaluate the position a company is in. But it's not intended to be this process of, scary auditor, scary regulator. But inevitably, it's going to have that feeling for a company. It's a test for them, and that's kind of the way they look at it. We do view it as trying to provide positive information, sharing information that we hear in the industry, so that companies can work from that. What we see from some of the better companies is very simply that they'll look at it as a learning experience. when we're asking about issues, it's a learning experience, and they'll look to kind of go back to their management team and understand what are we doing about this issue? AM Best asked us about it. It must be an important issue. But inevitably, there's going to be a case where companies are, I don't know if afraid is the right word, but cautious, concerned when they're talking to AM Best. But those that are doing a strong job come in very confident is the way we typically see it.
I read on a leading insurance company's website here in America that they received high marks from AM Best, a well-known organization that provides insurance ratings based on each insurance company's financial conditions and ability to pay claims. Why does a company need or choose to have an AM Best rating? Is it for advertising or is it for reinsurance? What is the value to the company?
I think there's many different reasons. You mentioned a few. The reinsurers view it. It really comes in as a third-party perspective of the organization. And it's more, sometimes we're referred to by some organizations as the de facto regulator. But we don't view ourselves as a regulator. We do one portion of a huge job that regulators do. But we do evaluate financial strength. But the difference between us and a regulator is the regulators pretty much pass-fail. From AM Best, we're looking at it from a spectrum of financial strength and who's stronger capitalization, who has better performance, who has a better position in the marketplace and provides better service and services their clients better, that protects their overall operation. It really is one of these things where our rating comes back to being that kind of stamp of a level of strength, a level of performance that a company has. So you'll see reinsurers that look at it. Regulators often look at it. When you go outside the U.S., you'll have companies that are looking at it from the perspective, or countries that are looking at it. When you want to go from one country to another in operation, that regulator very often looks at it as, well, okay, you're rated by a regulated rating agency. We accept that as being kind of a stamp of approval for acceptance into the country. Ultimately, third parties can look at it. If you're operating in terms of a contractor and do you have the rating, it just ensures that somebody can look at it and say, okay, somebody evaluated this organization and they have that financial strength, a stamp of approval that's out there. But it's really something that's built up over years, and we've been in business since 1899, reporting on companies. We've been assigning ratings since 1905. And
wow.
That history has built up. The number of uses just continues to build up. Historically, it was written into a lot of regulations in terms of you have to have an A rating to be accepted on business. So over time, the uses have continued to increase, but it really comes back to the evaluation of financial strength.
I guess I'm assuming that companies come to you and ask to be rated so that they can move forward as a company. Is that how that works?
They do. We don't rate everybody. They have to. It's a voluntary process. It's not we don't go in and assign ratings to a company that doesn't ask for it. So they'll come to us. We'll walk them through the process of what can be done. And it can be anything from a brand new startup, which is a business plan and a management team with a knowledge base and a book of business that they want to start a company, to a company that's been around for 50 years. We will evaluate their operation in terms of the governance, the management team, the potential performance. If it's a startup, the new business that they expect to have on their books, and their knowledge in the insurance industry and in their specific market. But it always starts with them approaching us. We will approach companies and ask them, would you we think a rating might be of value to you, and here's why we think it'd be of value. But they can always close the door on us, and some do.
So those carriers are your customers? They
are the people we provide service to. It is, we follow what we refer to as the issuer pay, which is that, the company is what pays for a rating, as opposed to a subscriber pay basis. But the other customers are the users of the rating. So it's kind of, there's two sets of customers.
Right.
It really is, the company decides there's value, we're going to get value, and the value goes to because of the people that utilize the rating. And if nobody's utilizing the rating, then a company's not going to want to get a rating.
So it's a circle.
It is. There has to be a demand. And I think our track record is what creates the demand. Mm-hmm. And thus companies typically come and to get a rating from AM Best for that reason.
So is AM Best the only rating agency there is?
No, absolutely not. I mean, there are others. Others are more focused. Some are more focused on the capital markets where companies issue debt, and they're more focused on rating the bonds that companies would issue than they are on the financial strength. They might not go as deep into the insurance industry as we do. They might only rate publicly traded companies. I think they would provide the service if requested, but they don't make a big push for it in that regard. There are also smaller rating agencies out there that have their own niche that they look at. It all comes back to who's demanding what ratings and why do the ratings provide value. If you're not providing value, nobody's going to want to get the rating. And I'd say, you ask, are there other rating agencies? There are other rating agencies that provide coverage across all industries. And I always tell our analysts, we have to be the best at insurance. If we're not the best at insurance, why would somebody want to come to AM Best? Because they can get insurance and all the other industries from somebody else. Our focus being on insurance, we have analysts that come from an insurance background. We develop people focused on an insurance background, whether it be actuarial exams, underwriting issues. We also develop them with certified financial analyst accreditations. So we focus on developing towards insurance analysis.
So tell us the story, how you got into insurance as your focus. Is that how it all started in 1899?
Yes. Actually, AM Best is a person, but Alfred M. Best started the company in 1899. He started by reporting on companies because at that point, the regulation was there's much weaker environment for regulation of insurance companies. And he started reporting on the financial strength of insurance companies. And then in 1905, the New York regulator asked Mr. Best to actually to rate the surplus lines carriers in the state of New York, which were at that point unlicensed, but they could come in and write business. And the regulator wanted to better understand the strength of these companies that were coming in and writing business on an unregulated basis. So he set up a system to evaluate companies in 1905 in that manner. And then in 1906, he expanded it to all companies that are operating in the U.S. He started assigning ratings in that manner. At that point, it wasn't necessarily in the same manner that we do it now, where it's based on a voluntary basis. He actually went out, got their financials, and assigned a rating to them. So it was an involuntary basis, but started assigning the ratings, and it provided value for people. So there was a demand for those ratings, and that's how the business started and has worked through over for probably the first 80 years of our existence. We were the only rating agency that was focused on insurance financial strength.
Mm-hmm. Wow. Mm-hmm. And over the past year or two, longer than that, but over the past year or two, I mean, ratings are always at the forefront of the news, especially whenever we talk about the Florida market, right? There are companies who have become insolvent because they can't get the reinsurance because they weren't rated correctly, in a nutshell there. But I mean, is there a lot of pressure on you as a rating service to make sure that you're always accurate in your findings? What is your QA process like whenever you go through something like that?
Yeah. I mean, obviously I won't call it accuracy. It is an opinion, but the quality of the assessment and the rating that we assign is extremely important. That's our calling card. And if we have companies that are highly rated that are failing, obviously that's going to lower the demand of the ratings. And all of the rating agencies that are regulated by the SEC have to provide what is referred to as a Form NRSRO Exhibit 1. And what that does is it looks at all the ratings that were and what their rating was a year ago and how many of them failed. 3 years ago and how many of those failed, and 10 years ago and how many of those failed. So it does provide a track record for anybody that wants to look at it. And if you just Google the rating agency you want and Form N or SRO, you'll find that track record on every company. So you mentioned Florida. That comes down to the issue of homeowners and what the ratings are that are there. You need a rating for insurance. And you need to have insurance from a rated insurance company with a certain acceptable rating for Freddie Mac and Fannie Mae. One of the issues there is what's the standard that they establish. When they first established all those standards, not all the rating agencies were providing the Form N or SRO. When they first accepted AM Best ratings, we were not SEC regulated. We weren't providing the Form N or SRO. But now, all the rating agencies that are out there are providing the Form N or SRO, and you can look at the differentiation between them. And part of the issue is when you look at Florida, we don't rate many companies in Florida. Most of the companies we rate are subsidiaries of major companies that are writing in Florida. You'll see that there's a lot of acceptable ratings per Freddie and Fannie's level from rating agencies that, other than AM Best, because those companies can't get the acceptable rating for an AM Best rating. It's just because there's different standards. Each rating agency establishes their own methodology, and that methodology results in the standard of their ratings and what I refer to as default ratio, which is basically, I mentioned how many companies default after 1 year, 3 year. So
10.
Their methodology will ultimately give them a grade and what their default ratio is. And what you'll see if you look at the Form N or SRO is the default ratios are different from rating agency to rating agency. And that's why a company in Florida, not many companies in Florida can get an acceptable rating from AM Best, because we do have a higher standard in our methodology is the way I look at it. Otherwise, we wouldn't have that stronger default ratio.
Is it a higher standard, or are you just looking at aspects, different qualities of the company than others do?
You could say we look at things differently. For the most part, I would say we would all purport to be looking at similar things. It's how you look at it. For example, there's one rating agency that markets down there that they don't use a capital model. We use a capital model. We look at the model, the catastrophe exposure that comes out of the catastrophe models, and we look at the capital in a modeled basis and look at the likelihood of default based on that capital model. In other cases, it's probably just a different perspective, but the reason I say we look at it at a higher standard is because we can't get to those same ratings. So if we can't get to the same rating looking at the same thing, it's typically because we do have a higher standard in terms of what we're having. Usually it revolves around the catastrophe exposure and their ability to absorb catastrophe, as well as the ongoing track record. We will look at a company and say, well, yes, you have plenty of capital today. And when you look at an insurance company, they file their financial statement, but you get it 3 months later. So you're already 3 months behind where their capital is and how much money they have in the bank.
Right.
Their operating performance and are they making money or losing money is going to continue to move that where they're at over time. And then their business profile is what protects that profitability. So profitability is tomorrow's capital. And if you have a company with lots of capital but is losing money, we tend to place a fair amount of weight on that, because claims are not paid today. They're paid down the road. So that profitability and exposure to a catastrophe, the level of exposure to a catastrophe, may mean that you might be fine when you buy your policy, but 6 months later, that company won't be there.
Well, exactly. I mean, just because if there's to use your 3 month, 3 month in arrears statement, mm-hmm. you could have a hurricane in October.
Yep.
And you could look really good. I'm sure your financials could look perfectly good in October, right? And maybe even in November.
They might even be good. I was going to say they might even be good at year end because the claims, it takes a while for the claims to accumulate and be filed.
But obviously, one of the primary reasons for ratings of insurance companies is reinsurance. And there are reinsurers that are accepting ratings from these other ones whose standards may be different or analysis may be different. Is that because reinsurers? I mean, how do you explain that? When
you look at what rating you're using, everybody's got a view of the rating they're using. So it's not like somebody will say, well, that rating provides no value. It's just when you use it, you consider what the rating is and what your comfort is with it. Somebody else might be perfectly comfortable with an AM Best rating or another rating agency's rating at the same level. Whereas another person might say, well, no, AM Best, I don't believe in AM Best rating. That's all a matter of opinion. And we're providing information because a reinsurer is going to do their own due diligence too and look at it and say, yes, I see value or I don't see value in an AM Best or one of the other rating agencies, and how much credit do I give it when I go to write my reinsurance program with that company.
I'd like to talk a little bit about how insurance has changed. In 1905, AM Best started out, with insurance companies, and insurance companies were insurance companies. And today we have seen this huge rise in MGAs or MGUs who are writing on behalf of insurance carriers. Now, I was just curious, is there any rating or is there anything that AM Best does for the MGAs or the MGUs out there? Is there anything being done right now for them?
Absolutely. We just started recently because of the growth in MGAs, and we've seen tremendous growth over the last 5, even probably a little before that years. 5 years, we've seen a tremendous growth in the use of MGAs. Some of it relates to, you guys look at a lot in the InsureTech space. Some of it relates to the InsureTech aspect, utilizing their expertise in the underwriting of business and then placing it with carriers. What we saw was with the growth of MGAs, we felt it was important for us to look at the MGAs more closely because they're the people doing the underwriting and in some case claims handling and providing that service to the insurance companies. They can have a material impact. And we've seen it historically. If you go back into, say, the 1990s, MGAs created a real risk for the companies that really concentrated on their use. So this performance assessment we have looks at the overall performance, the underwriting quality of an MGA. It looks at the talent and training of that the MGA provides to its people. So if it's just a 2 or 3 person shop, or is it 100 people with actuaries on staff, which many MGAs have now, we look at that. We look at the financial condition of the MGA itself, and then the breadth of programs that they have and the relationships they have with companies and the longevity that they have. Because if you're an MGA that's moving from company to company, there's a misalignment in the business that you might pass to a company. Because an MGA gets paid mainly on a commission basis, just a percentage of the premium, whereas the insurance company has to pay for the losses that come through. Right. So this program, we refer to it as a performance assessment, and we refer to MGAs and all the other types like companies as delegated underwriting authority enterprises. Basically, they have delegated authority from the companies. And it fits to our purpose because with the increased growth in MGAs, they are managing a larger and larger portion of the business that companies are taking on. Sure. And will have a bigger impact on insurance companies. So we want to look at it. It's a material impact. It could be a material impact on a whole different organization's ability to pay claims. Mm-hmm. Right? I mean, yes. the way that the MGA is behaving or writing business could, in an extreme, bring down
that underwriting company, the insurance company, the carrier that's backing the line of business.
Yep.
Right. I mean,
absolutely. And we've seen it, as I mentioned, in the 90s, there were issues related to it. We saw already this year, I think it was Trisura that took an $80 million Canadian dollar charge for the fact one of their MGAs didn't have the appropriate reinsurance in their captive, and that loss rolled back over to Trisura. So the insurance company had to take on loss that it wasn't expecting because the MGA didn't properly manage their business.
And so is that AM Best Rating Services goal to be able to put this approval, this rating on an MGA so that they can go to carriers and it'll kind of stand on their own 2 feet? Is that the goal of AM Best?
Well, it's similar to the rating. I mean, we believe it provides value, and we believe it provides value because we provide a third party perspective on it. And I've heard many people say, well, look, we already do this evaluation. We don't necessarily need you to do the evaluation. Well, it's very similar, again, back to the rating. We're providing a third party evaluation. We're taking away the relationship aspect that a company and an MGA might have and looking at it from a third party perspective and providing that perspective that's there. We've had interest from regulators in terms of what are we doing and why is there value in it. And in some cases, it started out with a regulator saying, well, why would AM Best be doing this? What value is it? And when we have the conversation, they understand that just like a rating, the third party evaluation and assessment does provide value to the industry for usage. And it's additional knowledge for them to use. Ultimately, the insurance company has to decide, are they going to do business with the MGA or not?
So let's talk about InsureTech. Is InsureTech and InsureTech insurers, because InsureTech is much broader than just carriers or carrier-like entities. Is that a wrinkle for you guys? Tell us about the relationship that you have with the InsureTech world.
I view the InsureTech space as an innovative lab for how insurers can manage their business. In some cases, it's solutions in service. In other cases, it's providing information for their underwriting process. The InsureTech space is just another approach to insurance and what's going on there. So what we're trying to do is we always want to make sure we understand the new technology. What are they doing? What are the different ways they're looking at risk? And how does that then impact an insurer? And in some cases, the InsureTech organization is the insurer. If you look at like a Hippo or some of the auto writers, they're utilizing the technology and they're actually taking the risk on themselves. In other cases, it's service and technology that is bolted on to insurance carriers to help them evaluate risk. But we need to understand that process. And then it goes back to the same old financial strength, I think, that we look at of, do you have the capital, or, how are you evaluating the risk and underwriting the risk, how you gather the data and what data you're looking at will have an impact on your overall risk profile as an organization. Mm-hmm.
Mm-hmm. Do you have InsureTech companies coming to you and asking for your services?
A few. Again, I think in some cases they have, they prefer other rating agencies because they need a rating for the capital markets and what they can get. Because for them, it's all about making sure they continue to generate additional capital to grow, because they're looking to grow their business. In a lot of cases, there's very few of them that are actually taking on risk. So we don't necessarily go out and just rate an InsureTech in one way. The PA is some aspect, the performance assessment, because if they are underwriting risk for carriers, we can evaluate them that way and assess what they're doing and how they evaluate risk and what their service is to the carriers. But it's, for the most part, right now, what we're seeing in the MGA space is a service provider that it doesn't fit our spectrum of how we evaluate things.
You must have a lot of data, right? You've been rating companies for over 100 years. Mm-hmm. Are you seeing that companies are getting stronger, or with increased competition, increased number of insurance companies, MGAs, InsureTech starting up, are companies getting weaker, or are companies getting stronger?
I'd have to say companies are getting stronger. Just like you mentioned, we have more data, they have more data. And I go back to when I was an analyst and I'm sitting across the table from a CEO, and the CEO is telling me, we will never write to an underwriting loss. And the only thing going through my mind was, I wish you would tell your underwriters, because they sure as heck are writing to an underwriting loss. Because he didn't have the data. Now, these CEOs have the data the next day. Right. It used to be you'd get a monthly report. The data is right there, and especially the companies, the startups in terms of the technology, they don't have the legacy data issues at all. Everybody recognize insurance companies, because they're about data. There's a lot of older insurance companies that have the legacy issues with their data, all working through it. But they all have gotten to the point where they really do have good information real time. The old cycle of really high loss ratio, strong, lower loss, increased premiums and lower loss ratios and back up. You don't see that volatility anymore. You see it micro in certain markets because, I don't know, claimants understand a new way, or a lawyer gets involved in something, and all of a sudden you get a spike in claims. But it takes some time to work through it. But for the most part, companies are much more quickly addressing those issues and are able to underwrite in that manner. And to your point, we have a lot of data, and it allows us to look at things closely. And I think what it does is it makes our discussions that much more fruitful, because there's so much more information to get behind when we talk to the companies. Right.
I'm curious about you say that it generally, in a general sense, high level, the companies are stronger. You hear a lot. Lee and I work for Alacrity Solutions. We're involved in the claims end of the business. And we hear a lot about profitability and complaints about profitability and pressures about profitability today, most especially in the personal lines market, because of inflation, both inflation, how inflation affects property, and how inflation affects auto. And I'm sure that one of the interesting perspectives that you guys have is the perspective of performance over time, right? And things that are trends that were probably catastrophic trends, who knows, 60, 70 years ago, that eventually faded and went away. Is that how you look at that perspective of time? Does that help you guys look at and counsel about how things are today, and understanding and putting it in perspective?
Well, I think there's always changes in the industry that constantly are evaluating. We're evaluating what that impact's going to be. You mentioned the property and the trend. I mean, you've seen announcements from State Farm, Allstate, Nationwide now, and all of them. And you brought up inflation. I mean, I spoke at the Casualty Actuarial Society last month, and to me, as an actuary, that's the biggest issue you're going to face. It's easy to project losses when inflation is 2%, and it's been 2%, 2 to 3% for the last 20 years. When you start seeing inflation go up and go down, that's where actuaries, it's almost an impossible job to project where losses should be, where rates should be, and it makes the job that much more tougher. And to Lee's last question, is the industry in a better position? It absolutely is on a capital basis. It has more capital, but the risk continues to change. You have the inflationary aspects, you have climate change, and what's going on with what used to be thought of as, well, the secondary perils of tornado or hail or things like that. If you were concentrated in Kansas, you had, you could really get hit hard. Now it doesn't matter where you're located. It seems like you can get hit with a tornado, and if you're concentrated, that's going to be an issue. So they're dealing with so many new risks, but that's the whole aspect of the insurance industry, continuing to evolve and figure out how to manage it. Some of it comes back to the good old fashioned insurance theory of diversify your risk and making sure you're not concentrated in there. We are always talking to companies about how are they ensuring that they're in front of their risk of if it's concentration of risk or changing or legal issues, whether you're regulated by a state, whether it's a regulatory issue within a state or it's weather. What is it that you're doing to manage your risk, and how are you staying focused on it, staying ahead of it?
I want to talk about banking for a minute. I know you guys don't rate banks, but the failure of Silicon Valley Bank, Signature, and a few others obviously occupied a big spot in the news for 15 minutes, and still a concern. How do you guys view that kind of trouble? And could something like that happen in the insurance industry?
If you look at Silicon Valley Bank, it absolutely could happen in the insurance industry on the life side, particularly where you're talking about long tail issues and risk and managing the whole issue of interest rate risk. We're constantly looking at the asset management of organizations to make sure that they are properly invested. If you're long on if and that's the issue with Silicon Valley is that
right.
they had long investments at a low interest rate environment, and when interest rates went up, the value of their assets went down. We're constantly looking at companies from that perspective on the life side, and then even on the property casualty side, the same type of thing. If you're a medical malpractice writer or somebody that's dealing in longer tail liability, how are you managing your assets to ensure that you're properly allocated to minimize the risk? You're not going to get rid of it. Let's face it. If interest rates go up, the value of your bonds that you hold at paying 2% is going to go down. Going to happen. Mm-hmm. But are you managing that risk so that if interest rates do go from 2% to 7% or 6%, that it's not going to put you underwater in terms of the level of capital? And then the other issue is, what is your short-term cash need? We're more concerned in that type of environment with a catastrophe writer that could get hit tomorrow with a cash need on the property. See, on the life side, you have the whole issue of disintermediation, and you could get a run on the bank and people say, I want my money. On the property casualty side, you can't go to your insurer and say, I want my money. Right. There has to be a reason for a claim. Right. So then it comes back to, okay, what type of business are you writing? And the one that always will get you is if you're writing, Florida homeowners, you best not be invested in long-term securities and write Florida homeowners. So we are constantly talking to companies about the management of their assets and how it fits together with their liabilities and what the risk is and how do they manage their risk. That was the issue with Silicon Valley Bank. I looked at it, I was smart enough to look at the fact I had a variable rate line of credit in February of 2022, and I might want to turn that into a fixed rate before the interest rates went up. I can't understand how Silicon Valley Bank missed that. Yeah,
they were bankers, right? That was kind of the fundamental part of their job, like you're saying.
Absolutely. That's what bankers are supposed to do, and they missed it.
Mm-hmm. I think that all the repercussions of how the macroeconomic environment has changed are just different today, and it happened in a year, right? It went from this long-standing low interest, low inflation environment to not in a short period of time. And if you were busy having parties, you might have missed that.
And just related to, back it was probably 20 years ago when the whole issue of enterprise risk management started to be become discussed and everything. Now companies, and it goes again back to the question that Lee asked about, are companies in a better position? They are, because they really truly are looking at the risks that could occur. They're doing many more scenario tests and understanding what could impact them down the road. They're not going to find everything, but most of them, like the good companies, are looking at it from the perspective of what if.
Mm-hmm. Mm-hmm. So first of all, we're very grateful to have you with us today. This is a real kind of a privilege for us.
Yes.
To be able to speak with you and for you to give us the time. We're very grateful. There's one question I'd like to ask you on the way out, and that is, you guys give your opinion. It's an opinion, as you keep saying. I want to talk about climate change for a second, because climate change, depending who you talk to, climate change is an opinion. It's real. It's not real. But setting the political discourse aside for a second, how are you guys looking at climate change? And you're probably looking at it by the numbers, right? I mean, not by opinion, but by gut feelings. What are the numbers telling you? And I'm interested in the perspective that the perch that you guys have relative to that.
Yeah, and it really does come. You nailed it. It comes back to, we're not going to get into the debate of climate change and what's there. We look at it from climate risk and say we know that things are changing. Wildfires didn't really have a major impact on insurers until 2017. And since then, look at the wildfires that we have going on. And so companies, what we're saying to companies is, how do you manage that risk? There's risk of it now. So you have to be prepared for the fact you may write in the wrong county in California and have a problem, or Colorado. How are you managing that risk? And same thing with hurricanes. The hurricanes, the numbers over the last 20 years have been very high. In a lot of cases, been very lucky that they haven't hit where they're at. I go back to, I was actually in one of the islands when Hurricane Dorian went over, and it went right over me as a Category 1. No issue. It made a left turn and was, if you remember, it was headed straight at Miami as a Category 5, and then made another right turn. What if it didn't? What would you do? What are you doing as an insurance organization? So we look at it from the perspective of, things have definitely changed. We're not trying to we're not really focused on the why it's changed. We know it's changed. What we're focused on is, how are you as an insurance company managing that risk of what could possibly happen in this new environment?
Mm-hmm. So you look at it from a perspective of, this is what the numbers tell us.
Yep. That we know, because we know there's more risk out there. We know the level of catastrophe losses globally have increased. And again, we rate companies all around the globe. So it's not just in the US, but look at Asia and what's going on with the typhoons over there and the floods, and because different countries have different coverage issues. Mm-hmm. But what are you doing? Because you know that these disasters are occurring at a more frequent rate, and they're just as big as the bad ones always have been.
So do you think it's fair to say, downstream, as a consumer of insurance, like the three of us are, mm-hmm. right, in our personal lives, it's just going to cost more?
Absolutely. I mean, the best example I have, you look at Florida, and I hear people, I have friends, all my coverage for homeowners insurance is so expensive. It's like, well, let's look at where you live and the number of hurricanes and the losses, the average losses from those hurricanes. Then throw on top the fact, up until they passed a lot of regulatory reform, you had one of the worst litigation environments for insurance in the country. I think it was something like 80% of the lawsuits, homeowners lawsuits in the country came out of Florida. Yeah. So put those two together, and there's no way you possibly can be, dealing with all the losses that could come through. And everybody, because the catastrophe risks across the country have gone up, everybody's seeing increased losses. And that's why Nationwide's looking at it from that perspective. Yes, trend is an issue as well. But, these larger companies are looking at it and saying, we got to get a handle on these losses before we can get comfortable. And if regulation will not allow me to get the proper rate to pay those losses, I have to do something different.
Absolutely.
All very interesting, and we've eaten up all of our time, and we haven't even talked about you. So I apologize for that. But this is how we trick people into getting them to come back on our podcast a second time. Is you just can't cover everything in the short amount of time that we have. But what a fascinating, interesting business you run. And again, thank you so much for being with us. We really appreciate it.
Yeah, absolutely. I mean, I guess I'm a little bit of an insurance geek, and so I'd be happy to. I'm always happy to talk about insurance.
Cool.
Love it. Thank you, Matt, for being here.
Thank you.
Thank you.
That was really interesting,
wasn't it? Though.
Yeah, we don't usually have the CEO of the major insurance rating company on our podcast. That doesn't happen every day.
It was a big deal. Everywhere you look, AM Best is mentioned in the insurance space.
Yeah.
And it was a really great conversation. And I've enjoyed getting to learn more about them. They have this whole other side of their business, the information side. We didn't even talk about. We talked about ratings today, but AM Best is they're a big factor in the insurance space.
Yeah. Data, it's a data mine, right? I mean, can you imagine the data that they possess and the sway and the influence that they do? But he seems like just the right kind of guy to have.
Yeah.
Because he's very humble and down to earth and has a great handle on, what they do.
Well, he's been there forever. I mean, a long time. Close to 30 years.
Right. Well, we can't, the whole AM Best organization has been so good to us. They were great to have us on their show, and we're thrilled. We held them, we hijacked Matt, actually. We threatened them to get them to do this. And they gave up Matt as a sacrificial lamb. And as you heard, he was a great interview. And so
yes,
our thanks to all of AM Best. And their whole media area, as well as to Matt himself. And thanks to you all for being with us today, once again, and putting up with us. And I'll say thank you to Alicia today, because Alicia's nice, but I'm not going to say thank you to Al, because Al's not nice.
That's not nice.
Well,
I think Al is fantastic.
Turnabout is fair play. And so we'll say what we say every time when we depart the podcast universe, and that is
goodbye, everybody.